Hi there, welcome back. Having shown you the prototype of a financial statement, what the financial statement of a small business should look like, it's now important to also be able to analyze the figure in the financial statement to make sense of them so that you can make proper business decision. And how do you do this? Number one is you need to watch out for your profitability ratio. And for your profitability ratio, you want to look at the revenue growth, right? How has your revenue grown comparatively? Looking at the statement of income that was shared earlier on, it showed that the revenue of the company actually declined from by 1%. The revenue that they earned in 2025 declined by 1% compared to what they earned in 20x4, right? So what this is telling us is that the revenue of the company has dipped, and the interpretation of this is that this might have been caused by several reasons. Number one, it could be because of the fact that probably the company lost a percentage of their their market share, right? And what that means is that would translate to reduction in quantity of goods sold or service rendered. So that way, that will also affect, of course, the revenue of the business. So two things, it could be the quantity that was sold, it could also be caused as a result of the price. Perhaps the company had to take a price cut, maybe because the competitors are now selling the product at a relatively lower price, right? And it could also be as a result of regulation. But what this is just telling us is that the revenue of the company dipped by 1% in the current year compared with the same figure in the previous year. Now the next is gross profit margin. What does your gross profit margin measures? It tells us the amount of profit you are able to make, right, after deducting your direct cost from your revenue. And that is why the simple formula for calculating that is gross profit over revenue. From the financial statement that was shown earlier, it shows that the gross margin of Ailey Finance is 99%. What does that mean? It means that for every $100, for instance, revenue earned by the company, they are able to make 99% as gross profit. You could say that looks great, looking at the fact that the company is able to generate more profits as per its direct costs. So what that is just saying is that the company is able to generate more return, and you can say that they are able to also manage or put controls in place to manage their direct costs, to make sure that their direct cost does not take a larger part of the revenue they earn, which is something that looks great and is a metric that as a small business owner you must pay attention to. In fact, before you make pricing decision, you should also look at the gross margin. If I decide to sell this product at this price, how much will I earn if I deduct all direct costs? Recall, direct costs are costs that are specifically attributable or that are directly chargeable to what you are producing or the service you are rendering, to that revenue that you have earned. A good example we gave earlier on in earlier lecture is a salesman commission, right, for a product that, or for a revenue that was earned as a result of the salesman efforts. Now the next one is return on capital employed. Very, very important. This is an important ratio that you must also pay attention to, which is calculated as profit before interest and tax, PBIT, divided by your capital employed. And of course, your capital employed is your total assets minus your current liability, right? What this is just measuring is that how much return are you able to make from the capital you have employed in the business in just a very simple term. And from what we saw here, we saw that the capital employed rate is 136%, which means that the company is able to generate more return as per the capital they have employed. And what this means is that for every $100, right, of capital employed, the company is able to generate 136 naira, $136 in profit before interest and tax, which looks good for the business. It means that the capital employed in the business is able to generate great returns. Now, the next one you also want to pay attention to is return on shareholders' equity, right? If your business, if you have shareholders who have invested in it, you also want to be sure what is the return they get, in exchange for their investment in your business. And how do you calculate that? That will be profit after tax, because profit after tax is what is left after tax has been paid, after everything that needed to, every expense that needed to be paid has been paid. So profit after tax is what is attributable to the shareholders, to the owners of the business. So if you divide that by the shareholders' equity, the value of the capital that the shareholders have invested, what we have as per Ailey Finance financial statement is we have 186%, which is also an excellent ratio, which also tells us that the shareholders will be happy. Yes, it's a good day for them, because the money they have invested in the business is bringing a return well above, close to 2x of what they have invested. So it's also a great return for them. Another ratio that you should look at is the liquidity ratio. So liquidity ratio tells us how liquid a business is, how they are able to convert cash, how they are able to convert their asset to raw cash. And one of them is current ratio. Current ratio measures the ratio between your current asset and your current liability. This one is just saying the assets you have now, when you sell them as we speak, are they able to also cover for the liability that you also have now, that you have for this period? If they are able to cover for it, then you are good. It means you have cash to pay for your current liability, the debts that are standing. And the industry benchmark generally for current ratio is 2:1. It means that your current asset, when you sell all of them, it should be 2x your current liability, which makes sense, right? Then the next one is quick ratio, because current ratio uses the entire current asset. Quick ratio is now saying that inventory, that is the stock of goods you have, you may not be able to convert them to the equivalent cash due to so many reasons. So it's now saying that, okay, we need to recalculate the current ratio by first deducting inventory from the current assets. So that's why the formula is current asset minus inventory over current liability. And from Ailey Finance, what we have is 1.70, which still makes sense, because that is telling us that, if you sell all our assets, apart from inventory, what we will generate, we'll be able to pay all our current liability, and we'll still have 0.70% cash left, which means the business is fine. You are able to meet your short-term obligation, which is what liquidity ratio is all about. Then the next one is cash ratio. We now look at all cash and cash equivalent, your marketable security over your current liability. Those are items, instruments that you can easily convert to cash without losing its value. Yes, relatively, right? So that is why the formula is cash and cash equivalent plus marketable security over current liability. Marketable security may be like treasury bills, those securities that you can easily convert. And from what we have here, we have 1.05, which is also telling us that the cash we have is enough to settle our current liability, and we still even have 0.05 left as cash, which is good, because as a business you want to be able to meet your liquidity need. It's important. You are able to meet your liquidity, you are able to pay your suppliers, you are able to pay salaries, amongst other things, right? So you have learned profitability ratio and liquidity ratio. As we proceed, we also proceed to other ratio as well, and you learn them as well, and you're able to also apply them and interpret them in your business situation. Thank you very much.